What I want to do, well, first of all, let me just say, it's nice to be back here. When I was active with the old Society of Real Estate Appraisers and the Appraisal Institute, I took several classes here with the Mingle Institute towards my appraiser designation and state certification. So this is kind of an old stomping ground for me. It's been a while since I've been here. It's good to be back and to see some folks in the audience that I recognize. And what I would like to do is go through this presentation. It doesn't take very long. And if you would please hold questions till the end, and then I'll take any questions you have and we'll double back to any slides that you want to see again. All right? And hopefully my mix of South Piedmont, East Tennessee accent won't be too off-putting. I know a little bit more than I may come across sounding like it's a trick. It disarms property. Exactly. Let's see if this will work. There we go. All right. So, as you well know, Mecklenburg County is in the process of revaluing all property for 2011. Now, I'm going to confine my remarks this morning to the residential real estate market. Truth be known, we're still reviewing data for commercial property, and we won't be sending notices of commercial property values out until March of this year. So that's all still in a state of flux. Anybody here that's interested in income producing property, I will tell you that for the first time, Mecklenburg County is going to try to send values out based entirely on the income approach to value, which is something we've never done. We've used income data to defend value estimates, but we've never actually sent a notice of value based on earth. So that's just a little tidbit for you to keep in consideration. Seems like as I move around, I'm going in and out. Do I need to stay this way?
Yeah, try that, yeah.
Okay, sorry about that. The obvious reason that we're doing this revaluation is because we're up against a statutory limit. North Carolina law requires that each county jurisdiction reappraise its property at least every 8 years. That's state law. And one of the challenges we have as county government staff is trying to help property owners understand that 95% of what we do is dictated to us by general statute. We can't postpone a revaluation. We can't not do one. We can't forecast values. We have to do everything by the book. And that's the way government works in general. We're a monopoly. We don't have competitors. We don't have a price system to tell us whether we're doing a good job or bad job. We have to go by the book. So, we last appraised in 2003. One of the big misconceptions that property owners have is that that current assessed value that they have on their property right now represents our estimate of the current value of the property. Not true. 2002 sales data was used to arrive at those 2003 reappraisal estimates. The market's gone through a lot of changes since that time, but even if a house was built in 2006, brand new house, the value that we place on that property is an estimate of what that property would have been worth had it been built on January 1 of 2003. So we have a schedule of values that applies to that world. We have just completed building a new schedule of values for 2011 that applies to the new world or the new reality of the market, if you will. All right, there are a couple of requirements that the assessor's office has. One of them is common to private fee appraisers. The other is unique to the assessment field. As all appraisers, we're interested in estimating the market value of the property. Just want to add that county appraisers who work in the assessor's office abide by the same uniform standards of appraisal ethics, conduct, and practice as private fee appraisers do. Our governing organization, the International Association of Assessing Officers, is an original member of the Appraisal Foundation in Washington, D.C., along with the Appraisal Institute. So we help write up the uniform standards. So we're not doing something different from what a private fee appraiser would do. Our process is different. We're under Standard 5 of the uniform standards, which dictates mass appraisal practice. So we use techniques that are a little bit different from a private fee appraiser, but it's based on the same three approaches to value: cost, sales comparison, and income. Where we differ from the private fee appraiser is we also have to bring equity to our assessments. This is a term that's not well understood, and I'm going to define that as we move through. First of all, let me focus for a moment on this idea of market value. You all know this from your classes that you've taken. Fair market value is the most probable price that a property would bring in an open market between a typically motivated buyer, a typically motivated seller, without the presence of undue stimulus. And in the world that existed prior to 2007, it was pretty easy to define what fair market value was, or what the most probable price was, or what the typical buyer and typical seller represented. But a new reality came about in 2007 with the bursting of the real estate asset bubble, which I'll elaborate a little bit more on momentarily. But foreclosures, short sales, bank sales, government sales, these have become more and more and more prevalent in the market. In fact, right now, if you read the Observer Sunday, you know this, Mecklenburg County now has a historic number of foreclosures that are equaling the number of qualified sales that we normally use in our appraisal analysis. So we have to factor the impact of those distressed sales into our estimates. So what was a typical buyer, typical seller, and undue stimulus has actually changed as the market itself has changed. We'll talk a little bit more about that as we go. Now, to come back to this idea of equity. Equity does not mean that we put the same value on every property in a neighborhood. Equity means that we're trying to equalize the effect of changes in the real estate market over time so that the tax burden is shared fairly between all property owners. So to make some points, real estate markets certainly are not static. The desirability of neighborhoods changes with time. Some neighborhoods, the owner preferences are to be in those neighborhoods. They're willing to pay a premium to get there. You see rising prices in those areas. Some you don't have a lot of activity, and sales remain rather flat over time. And then other neighborhoods, for whatever reason, lose their desirability, or they may be subject to some locational and economic influences that drive selling prices down. It's our job to capture those realities and reflect them so that people are fairly assessed. If we achieve the fair market value in every neighborhood in the county, then we're going to have equity in our assessments. Okay? All right. At this juncture, we talk about some common concerns that we hear in our office. Some frequent misconceptions that people have. The first and biggest one is that we simply do the reval to raise the tax base. Or, as I've heard on the radio from one of my good friends and former students, the reason that we do the revalue, how we get away with this, is we artificially inflate the value of property. Well, first of all, we can't do that because that's illegal according to state statute. Again, we do things by the book. Number two, it's a violation of appraisal standards, which we abide by. And thirdly, there's no incentive for us to do that because that simply creates a higher appeal volume, which means we're staying later, working appeals, and not getting the new construction listed. So There's not even an incentive to attempt to inflate the values. The reality is that if the market value in every single neighborhood in the county, and we have about 1,300 neighborhoods we've identified throughout the county, if the market value in those fell in every one, that's what we would have to appraise the property for. So we're not out to get a larger growth base for the elected officials to calculate their revenue projections on. And incidentally, I'm going to interject this because I know this is going to be a question from somebody here. How do we define neighborhoods? Some of them are simply self-contained subdivisions, but others aren't. In some of the older, more heterogeneous areas of the city and county, we may combine neighborhoods that are identified on a recorded plat and put those together as a tax analysis neighborhood so that we'll have enough sales data, comparable data, to arrive at our estimates. And again, we're trying to get apples to apples, oranges to oranges. So your clients are probably going to come to you and say, well, they've got me in this neighborhood, but I don't live in that neighborhood. I live, several blocks away. We combine those properties for analysis. We're not saying that you are in a different subdivision from the one you actually live in. Okay, we've touched upon this. The assessor's office doesn't take foreclosures into account. This has been trumpeted on the airwaves. I understand that. There was a lot of confusion early on. Late this summer, the Charlotte Observer interviewed us about how we handle foreclosures. And in good faith, we made mention of a suggestion that was made by the IAAO that if foreclosures comprised 15% or more of the total number of sales in the neighborhood, to include them in the analysis. We simply cited that as a recommendation. Catawba County does not factor foreclosures. It's my understanding that Rock Hill does not factor foreclosures into their analysis. We, on the other hand, have decided that because they are prevalent, we're going to include them in our analysis. So what does that mean? Those prices that are sub-market prices are going to have a dampening effect on the median sale price in the neighborhood. And what our appraisers aim to do is to arrive at an assessment ratio by neighborhood that falls close to that median sale price. So if foreclosures are there, they're going to pull down that value estimate. That's sort of an overview of how we handle that problem. We're also creating regression models, which we've never done before, that have a discount factor included. If you've ever seen a regression, it's just an equation with a bunch of variables: square footage, bedroom count, bath count, garage, whatever. And each one of those variables has a coefficient in front of it. That's the contributory value effect of that variable. And one of the new variables we've included in our modeling is the effect of distressed sales on the market area. And so that has a coefficient, and that will also help to give us a more realistic estimate of value based on the distressed activity that's happening out there. And then finally, this is totally understandable. A computer algorithm came up with my value. Nobody looked at my property. Everybody knows that the tax assessment is wrong. Everybody knows that nobody from the county has come out and looked at these properties in forever. We fully own the latter part of that statement. The only time that a county appraiser visits a property is when a permit is taken out, or as the movie said, if you build it, we will come. The permit